Well, I was on the show, the last show last year. It's just struck me. I was here with Fenley, and you know, interesting year.
And in terms of trading patterns, any big difference you notice?
Yeah, you know, a lot of people thought that the recovery, the economic recovery from the, you know, slump of 08, 09 was going to be very anemic, and that markets at best for 2010 were going to be flat, or we may even see a double dip. We were in the very optimistic camp, saying that we thought things could do a lot better than that, and it's been about a 15% year. Look, we've still got next week's trading session, and the markets in New York feel quite firm. But for the moment, anyway, we're up sort of 15, 16%. We're not quite yet back at the all-time highs. But if you look at the total chart pattern, that big run of our market in early 08 up to those kind of commodity price highs of around 33,000 change on the All-Z. We're not quite yet back at those levels, but certainly things are looking pretty good. The commodity stocks are not quite as high as they were back then. But the retail stocks and the industrial stocks amongst them have actually done pretty well and are at levels higher than they were back then. So all in all, a very satisfactory year, I think.
Absolutely. So those who have made the money have made the money. But would you go so far as to say that the easy money has been made here?
I don't know, you know, with markets, I don't know if there's ever any easy money. I mean, when you talk about the index, you really are talking about the overall market, and you're talking about sectors which have done well and sectors which have not done well. So the leading sector this year has been retail and pharma. So all of the ShopRites, the Massmarts, the Truworths, the Clicks and so on have done extremely well. And then also on the pharma area, that would be Aspen, Adcock, that kind of thing. The stocks that have underperformed, there's really only been one major sector which has been down for the year, and that's construction. And of course, that story I think is well known. It's the fact that private building activity is still very depressed. And, you know, some of the building materials guys are battling, and apparently government has got all these big projects, but it doesn't actually kind of make them happen, and the bills don't get paid. So those guys are still looking a bit depressed. But, you know, the easy money, I guess, if you called it right and you were along those particular sectors and not so heavily involved in the others, you would have done even better than the index. But I think if you look at the average investor's returns, I'm sorry to say, they normally do worse than the overall market because they time it wrong.
Right.
A lot of international research has shown that the adrenaline junkies who are watching the show now, they're always too scared when the market is bad and too excited when the market is good. So they tend to take profits too early. They tend to be out of the market when things look choppy or negative, and on account of that, their net returns are a lot worse.
Yeah, and some people actually say when you start seeing the retail investors coming into the market, it's time to run because it's the wrong time.
No, and so what you also see, I think, is when the retail investors start to send money to their favorite unit trust manager, that's when you should really be worried. But, you know, part of that, I think, is just a sort of a behavioral overlay. The underlying economic story, I think, that's important to get out there because it's often mixed, you know, with all the noise, people miss the signal. The underlying economic story is that there are nearly 7 billion people on the planet. All of them want to be rich. Many of them live in parts of the world that haven't traditionally taken part in the global economy. The system of economic capitalism with, you know, some degree of, you know, social amelioration by the state is an unchallenged economic model in the world. And steadily well-organized companies are doing well, making good profits across the world. So these global multinationals that drive the total overall equity market levels are doing pretty well at the moment.
Absolutely, and I suppose China is also joining that party. And incidentally, talking about where people are making money, I saw in earlier stories, in fact, saying the Financial Times has named Steve Jobs, the Apple CEO, as their 2010 Person of the Year because he has driven the iPad, and we know now the iPad is probably going to be one of the single most important device in terms of getting information out to people, and it's probably one of the platforms that people are going to use in terms of making money. But let's talk about the US economy in general. The numbers that came up today, from all the papers that I have here, and I've been trying to read up and trying to understand exactly the picture that's emerging, but the global picture I'm getting is that the US economy appears to be far healthier than people have been suggesting of late.
Look, the numbers today were not a solid beat. Everything was pretty much in line. I think the weekly initial jobless claims number was slightly better, but not by a huge margin.
The durables much better.
Take
away
the
durables. Aircraft.
So I think the picture is that for this stage in a normal economic recovery, it's sort of on track, although a little bit anemic.
Okay.
So there's no sign of any inflation in the US context. And a lot of the bearish gold bugs thought that all of the economic stimulus that was brought on by the Fed would by now have developed into Zimbabwe-style hyperinflation.
Right.
But I think that theory is now properly dead, indicating that there's still a capacity gap in the US economy and that there's not really much pricing power in the economy, which is what you'd like to see. I think the fact is a lot of people would be happier in the US if joblessness levels were lower. In other words, if the job unemployment situation, which skyrocketed from around 5% at the height of the sort of bull market down to about nearly 10% now, that doesn't seem to be kind of going down. But I think it reveals an important point about cycles. When the economy has a big crash like that, it's not as though when the recovery comes, everything does well and everything goes back to the way it was.
Right.
I think what this crash has done is it's forced many companies to reevaluate their cost structures and to move production, for example, to cheaper geographies.
Yeah.
And so those jobs are not coming back. It's just part of the new reality.
Right. So what themes then does one take into 2011, given what we've just, the case that you have just laid out, and also we do know that China has been growing strongly, perhaps far stronger than the authorities would like. And Europe, as we know, still has its problems. And people are suggesting that those debt wars are going to be with us come 2011.
I'm not too worried about Europe. I mean, a lot of people are saying the crisis of sovereign debt in Europe is going to be the major problem.
Yeah.
But if you look at those individual companies and countries rather like Spain and so on, their net indebtedness level are not particularly enormous. It's more a question of uncertainty with regard to the sovereign and political environment there. So debt levels in the US are quite high, but nobody cares about that because you've got the Fed and you've got the Treasury and everybody knows what they're doing. Yeah. In Europe, you've got this loose association of countries, you've got political structures which are not so well settled. So I think it's hard to know what exactly is going to happen in 2011, and I think it is a tendency of a lot of people just to say, well, the same thing that we're seeing now is going to happen then. But I would say on balance, I'm pretty positive. There may be some shocks, but I think those would be ones that we can't really anticipate now, political or natural disasters or whatever.
Yeah.
But overall, I think it's better to be in than out.
Would you be as strong as to say you would see the 15, 16s that we've seen this year in terms of our market returns?
The fact is that's the market average. So unless you're some kind of, crazy bull or bear, then normally saying that you think the market's going to go up by 15% in South Africa is like going with the middle of the road.
Right.
But I would say I was extremely positive last year. I'm like probably positive to slightly more cautious this year, just because everybody else has turned positive now. Maybe it's time to go the other way slightly.